Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at ACHR Aviation.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Because today we are looking at something that feels like it's honestly straight out of a sci-fi movie. I mean, picture the summer of 2028.
Okay, 2028.
Right. The Los Angeles Olympics are in full swing, and down below, the highways are just an absolute parking lot, like 3 hours of gridlock just to move across town.
Yeah, standard LA traffic.
Exactly. But you aren't down there. You're, looking down at it from a silent, zero-emission flying taxi, just bypassing the chaos completely.
Which sounds totally made up, but...
But it isn't. That is the exact reality ACHR Aviation is trying to build right now. The electric vertical takeoff and landing sector, or what they call EVT, is going through this massive transformation.
Right, we're watching flying cars actually transition into commercial reality.
Yeah, but for ACHR specifically, I mean, the stock has been under heavy pressure. They're trading down like 32% year to date. But they just crossed this monumental regulatory milestone that could honestly change everything.
Right, but navigating a stock with this much extreme volatility, it means we have to strip out the hype. We have to look at the hard data.
Oh, absolutely.
The actual cash burn, the execution, the strict timelines.
Yeah. And before we dive into that data, if you want help reading these kinds of volatile trading charts more clearly, you can check out VIP Algos through the link below in the description. VIP Algos is this TradingView indicator suite. It gives you visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even areas to plan your take profits and stop losses.
Which is super helpful.
It really is. You can use it across stocks, Forex, crypto, gold, indices, all of it. But just remember, VIP Algos is an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it obviously doesn't guarantee profits. Trading involves risk, so always manage your risk and do your own research. And this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
All right, let's move into the wealth building context. Because how does an ambitious, pre-revenue aerospace company even fit into a long-term portfolio?
It's a great question.
We need to be crystal clear right out of the gate here. This isn't your traditional defensive play.
No, not around.
This isn't an income-generating dividend stock that you just set and forget.
Far from it. I mean, this is highly speculative, high-growth, venture capital-style investing. You're just doing it in the public markets.
Right.
But the company boasts a staggering $6 billion order book.
Wow.
Yeah, that's a massive signal of future demand. But the wealth-building thesis goes way beyond just, selling aircraft. If they pull this off, they are effectively redesigning urban real estate.
And that is the crucial insight. Think about the economic ripples of that. If a miserable 90-minute highway commute suddenly becomes a quiet 10-minute flight,
right,
the value of land 50 miles outside a major city completely changes. You aren't just investing in aviation.
Exactly. You're investing in the decentralization of the modern city.
And this is a massive, but an order book of $6 billion is just a signal of demand.
Sure.
It isn't cash in the bank today.
Right, which means you have to be prepared to stomach some intense short-term volatility for this multi-year narrative. You're basically buying a ticket to that 2028 Olympic reality right now, knowing the ride between now and then is going to be incredibly bumpy.
And surviving that bumpy ride requires cold, hard cash today, which brings us to the reality of their current bank account.
That gives us the bigger picture. Now let's look at the fundamentals, because the numbers right now are, well, they're a study in extremes.
Totally. Let's look at the bearish reality first. In the first quarter of 2026, their revenue was just a tiny fraction of their expenses.
Yeah, just under $2 million.
Right. And against that, they posted a massive net loss of over $217 million.
Ouch.
Their operating cash burn was nearly $150 million in a single quarter. I mean, in the startup world, that's the valley of death.
It really is.
You're spending hundreds of millions just to build prototypes, run complex aerodynamic simulations, pay aerospace engineers, all long before you can sell a single commercial ticket.
The cash burn is intense, absolutely. But let's look at the bullish side of the ledger for a second, because they have incredibly deep pockets supporting them through this valley of death.
Okay, let's hear it.
They're sitting on nearly $1 billion in cash right now, like $951 million to be exact, with total liquidity extending up to roughly $1.78 billion.
So they do have a runway.
Exactly. They have the runway to execute. And if you look out to 2029, analysts are projecting revenue to jump to over $533 million.
Right.
But to understand why they're trusted with this much capital in the first place, you really have to look at their competitive moat.
See, a moat in a pre-revenue industry is a tough concept for me. Usually, a moat is built on brand loyalty or massive global scale.
Yeah.
Here, it seems to be built entirely on regulatory leadership.
Exactly. I mean, Archer's the very first company to close Phase 3 of the FAA's certification process. The FAA accepted 100% of their 797 means of compliance.
We should probably unpack that because means of compliance sounds like total bureaucratic jargon.
Yeah, it does.
In aerospace, the FAA doesn't have an existing rule book for electric flying cars.
Right, it's totally new territory.
So Archer had to submit 797 specific testing protocols, how they test the batteries against thermal runaways, how the rotors handle bird strikes, how the software handles a sudden loss of power. Phase 3 basically means the FAA looked at all 797 proposed tests and said, yes, if you pass these specific tests, we will legally certify you.
It's like agreeing on the grading rubric before you take the final exam.
Exactly. And having that locked in is a massive barrier to entry for any competitor trying to catch up.
And beyond the FAA, their moat is reinforced by these really heavy-hitting partnerships. Like, they have a conditional purchase agreement with United Airlines for up to $1 billion.
That's huge.
It is. And they also have manufacturing support from Stellantis. That matters immensely because, building one flying prototype in a hangar is a bespoke project.
Yeah, it takes thousands of man-hours per plane.
Right. But if you want to fulfill a $6 billion order book, you need an automotive-style assembly line that pumps these out reliably. Stellantis brings the supply chain logistics and the robotics that Archer simply doesn't have on its own.
And recently they announced a defense vertical lift program with Anduril, which is heavily integrated with AI companies like NVIDIA and Palantir.
Wow, yeah.
That opens up Archer's tech to autonomous military logistics. Like, imagine stealthy electric aircraft delivering supplies to the front lines without risking a pilot.
That's wild, and that unlocks non-dilutive government funding, which is massive for a cash-burning startup.
It is. But the skeptic in me has to point out that these partnerships, like the United Airlines deal, are conditional.
True.
If the timeline slips or the technology hits a wall, those partners can just step back. The fundamentals show a brilliant long-term setup, but an incredibly expensive short-term reality.
Which is exactly why the timeline over the next few months is so critical.
That brings us to the catalyst timeline.
Right. We need to look at what specific events will actually move the stock. First up, we have the Q2 2026 earnings coming in August.
Okay.
The market isn't going to be looking for a surprise revenue beat. They're going to be laser focused on that cash burn reduction.
Right. Because at a nearly $150 million quarterly burn rate, the market's calculator is constantly running.
Always.
They're figuring out exactly when Archer will have to go back to the well to raise more capital.
Oh.
Also, in the near term, there's a shareholder vote on June 26th regarding reincorporating the business in Texas.
Yeah, and a lot of investors might just gloss over that as administrative housekeeping, but it's actually a strategic catalyst.
How so?
Moving a corporate registration from Delaware to Texas is a massive signal. Texas has a really favorable corporate tax structure, a regulatory environment that heavily favors business expansion, and access to a massive aerospace engineering talent pool.
Oh, like what SpaceX and Blue Origin are doing down there.
Exactly. It signals that management is preparing the corporate structure for large-scale commercial operations.
It's an important foundational step. But the ultimate catalyst, the one that dictates the entire future of the company, is the advancement into FAA Phase 4 certification.
Yes.
Phase 3 was agreeing on the rules. Phase 4 is actually running the gauntlet.
It means flying the aircraft over and over, pushing it to its structural limits.
Right, and proving to the regulators that it meets all those safety standards. And Archer is targeting the start of U.S. commercial operations in the second half of 2026.
That is the finish line everyone is watching.
But I have to caution everyone here. Setting a target for commercial operations in the second half of 2026 is incredibly aggressive for a totally new category of aviation.
Very ambitious, yeah.
Is the market already pricing in a flawless execution of that timeline?
Yeah.
Because if they hit a snag in Phase 4, if the FAA demands a redesign of a rotor system, what happens to the stock?
That's the billion-dollar question.
Aerospace testing almost always faces delays. The stock is heavily reliant on a perfect regulatory runway.
Catalysts tell us what could change the story. Now let's pivot to the chart, because that reliance on a perfect timeline is exactly what's driving the price structure right now.
Right.
The stock has been trading around $5.50, which is down roughly 56.69% over the trailing year.
It's been a painful ride.
It has. But we are seeing the potential exhaustion of sellers. A material double-bottom chart pattern has formed right at the $5 psychological support level. It hit that $5 floor in March, bounced, came back down, and hit it again in June.
Think of that $5 level like a heavy-duty trampoline mesh. The stock dropped from its highs, hit the mesh in March, bounced up, and gravity pulled it back down to hit it again in June. The market is collectively testing the tension. Every time it hits $5, institutional buyers step in and say, okay, this is cheap enough.
Exactly.
They're providing the upward thrust, deciding that the mesh won't break. The sellers have simply exhausted themselves at that price point.
Right. In technical analysis, a double bottom implies that the market has collectively decided $5 is the line in the sand. It suggests the bleeding may have finally stopped.
But we have to remember that a trampoline mesh only holds if the conditions remain stable. I mean, it's like a weather forecast, right?
Yeah.
A double bottom means the storm might be passing, but you still carry an umbrella.
That's a good way to put it.
Because if a negative catalyst drops a massive weight on, like a delay in that FAA Phase 4 certification, that $5 floor could easily turn into a trapdoor.
Very true.
Charts show us the structure of past trades, but they don't predict the news. So the chart gives us price structure. But what does market sentiment look like? Because I'm seeing headlines about massive institutional sell-offs.
Yeah, right now, market sentiment is a serious tug of war. On one side, you have institutional selling making headlines. Like Cathie Wood's ARK Invest recently sold $12.7 million worth of their shares.
And ARK Invest is known for holding high-conviction, futuristic growth stocks.
Right.
So when a high-profile fund like that trims their position that heavily, the retail market notices. It feeds into a broader fear that maybe the timeline is further out than management claims. It's a clear sign of institutional anxiety.
It definitely makes headlines, but if we look at the broader institutional flow for the most recent quarter, 257 institutional investors actually added shares to their positions.
Oh, wow.
Yeah. So while ARK trimming gets the clicks, this isn't a mass exodus. What we're really seeing is healthy sector repositioning. Some funds are taking risk off the table, while others are buying the dip at that $5 double bottom level.
So the institutions are divided. How are the analysts synthesizing all of this?
Well, Wall Street is also divided on the exact number, but they lean heavily bullish compared to the current price. Analysts are broadly targeting between $9 and $12.
Sure.
Canaccord Genuity has a buy at $12, Needham is at $9, and 247 Wall St is at 11.51, which implies 127% upside from where it sits today.
That's a massive premium.
They're essentially saying that if ACHR survives the cash burn and hits the milestones, the current price is wildly undervalued.
But getting to that $12 target means surviving some incredibly brutal realities.
That sentiment picture is useful, but we still need to talk about the risks.
Exactly. We have to look at the execution risks, starting with dilution. We talked about their cash pile, but they still issued $8 million in vendor stock just this past May.
And let's explain what that means for a second. Paying with vendor stock means instead of using cash to pay the bills for parts or services, the company issues brand new shares to pay those vendors.
Right.
It preserves their cash runway, which is good, but it dilutes the existing shareholders.
Exactly. Every time they print new shares to pay bill, your slice of the pie gets just a little bit smaller. And their R&D spend is massive. It hit $171.7 million last quarter, widening their net losses by 133% year over year.
The sheer cost of inventing a new mode of transportation is staggering.
It is, which leads directly to the technological hurdles.
Right, because one of the biggest technical milestones in this space is called a piloted transition. This is when the aircraft takes off vertically like a helicopter and then midair tilts its rotors to fly forward on its wings like a traditional airplane, all with a human pilot sitting inside.
Aerodynamically, that handoff between raw downward thrust and forward wing lift is the most complex, dangerous part of the flight envelope.
Oh, without a doubt.
Think about the physics here.
Yeah.
During that 10 to 20 second window, the aircraft is moving too slow for the wings to generate enough lift to keep it up.
Right.
But the rotors are no longer pointing straight down. The flight control software has to perform an absolute miracle. Otherwise, it stalls and drops like a stone.
It's an aerodynamic nightmare.
Doing that with a dummy payload is one thing. Doing it with a human pilot in the seat is the ultimate test.
And the massive risk here is that ACHR still hasn't publicly demonstrated a full piloted transition, whereas their main rival, Joby Aviation, has already crossed that milestone.
I want to strip away all the optimism for a second and just warn everyone listening. If ACHR cannot successfully execute that piloted transition smoothly, or if the FAA demands safety changes during Phase 4, that second half 2026 timeline completely breaks.
Yeah, the dominoes fall.
If Phase 4 slips into 2027, the cash burn will continue at nearly $150 million a quarter. They will likely have to dilute shareholders heavily to raise more money. That combination could absolutely crush the stock price, breaking right through that $5 trampoline mesh. Protecting your downside is just as important as projecting your upside.
Absolutely.
Total failure is still a possibility for any pre-revenue aerospace startup.
So with everything on the table, what's the final verdict?
Well, bringing all this research together into a final balanced rating, the data gives ACHR Aviation a bullish score of 7 out of 10.
The investment stance here is that this is a high-reward contrarian entry right now, specifically because it's sitting at this $5 double bottom level.
Right.
But it is highly, highly speculative. Your horizon for this stock has to be a multi-year hold.
Definitely.
The entire thesis is strictly contingent on two massive external factors: surviving the incredibly rigorous FAA Phase 4 certification and successfully landing that LA 2028 Olympics rollout to validate their commercial model.
It is a crucial reminder that this opportunity is strictly for high-risk tolerant investors. If you lose sleep over a stock dropping 10% in a week, this space is just not for you.
Yeah, sit this one out.
And as always, this analysis is strictly not financial advice. And if you want a cleaner way to read trading charts, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make charts easier to scan, but it is still only an educational chart analysis tool.
Right.
It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if if today's talk helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.